Hello, I'm Graham Bibby, Chief Investment Officer. I'm here today to introduce you to Partners Private and the Causeway Corporate Credit Fund. Initially, I'll give you some background as to Partners Private and what it is. So the main approach for Partners Private is to bring institutional and niche opportunities to individual investors because we believe that individuals deserve better. For too long, investors haven't seen the opportunities that many large family offices and institutions see. We've raised $370 million across over 30 strategies since 2012. Why do we like private markets? Well, besides equities and bonds, private markets often offer you more returns and less volatility. And if you select well, even better returns again. There's many niche strategies underneath, and in particular, looking at the middle markets area is one particular approach. And you can also look at different strategies across the risk spectrum. And so with that in mind, we prefer to look outside of core, which is strategies that are nothing to do, fully leased perhaps if it's property, no real enhancements, to look for strategies that are increasing the returns with a bit more risk. So from core plus value add, where there's a bit of improvement, think about it like a property that needs some renovations. Or it could be something that's more opportunistic or special situations that might need development or some major repositioning. So we prefer the better returns from those areas with better managers who can address those areas well. We have a process and investment committee that supports the selection of this investment, and we do that through 4 people on our team, including myself. A very brief summary of our process. So we see a lot of opportunities globally. We don't just look for them to come to us. We do a lot of outbound research. And we have databases and contacts on thousands of managers. I will see 1,000 opportunities a year that come across my desk. And we whittle that down to as few as 100 to 50, and then undertake screening analysis, of which once we get through this process of due diligence, we're perhaps selecting 12 to 15 a year. The investment process includes deep due diligence into investments, legal, financial, and operational due diligence. And we have a rating process, and then that's scored. Through that process, some of those opportunities do get rejected, and we end up with those 12 to 15 opportunities a year. And with that brief introduction, I'd like to introduce you to the founders of Causeway Capital and the Causeway Corporate Credit Fund, Mike Davis and Tim Martin.
Thanks, Graham.
So to start off with, would you be able to give us an overview of the background and history of Causeway Capital and your history?
Certainly, Graham. So Causeway has operated in the corporate private debt markets here in Australia for more than 20 years. And our team on average has over 30 years of experience in debt markets. In that time, we've managed, as you can see here on this chart, more than 1.6 billion of assets and portfolios across Australia. And we currently have 90 wholesale clients invested with us in our private debt funds. And we also manage and advise in total over $600 million of assets across the sectors. Causeway has developed a proven track record in the sector in investing in Australian mid-market corporate debt. And based on research that we have had done over the years, the estimated size of this market is around $500 billion here in Australia and consists of more than 60,000 Australian enterprises.
So how you use that experience and background to execute this through the strategy and the fund. So could you describe the fund and its terms and what you target?
Certainly, Graham, and I've put a copy of the terms up on the slide here. The objective of our fund is to identify direct lending opportunities to growing businesses here in Australia that are well capitalised with cash flows to service the loans that we make. And what we're seeking is to provide consistent risk-adjusted returns for our investors whilst at the same time seeking to preserve investors' capital. So, as mentioned, we act as a senior secured lender to the lower mid-market. And the way we define that is businesses that are typically seeking to borrow somewhere between $2.5 and $25 million and are looking to borrow money for terms ranging from 3 to 5 years to maturity. But typically the average life of our portfolio pans out at around 2.5 years. So in terms of the security we're seeking as the senior lender, we're looking to lend generally against business assets. So this might include debtors, inventory, plant and equipment, and occasionally some property, although that typically represents a small amount of our exposure. The target return on our fund here, as you can see, is 9% or in excess of 9% over the full market cycle, and that's net of all fees. And what we're seeking to do is pay interest on a quarterly basis. And for the fund we've just launched with Partners Private, we will be paying our first coupon within the next couple of weeks. The fund itself is an open-ended fund, so it takes investments in on a monthly basis, and investments are initially locked up for 18 months to meet the average maturity profile of the fund, and then there are quarterly redemptions available thereafter, subject to liquidity.
So, Mike, going a little bit further into the type of companies and how you employ the strategy.
Yeah.
These are Australian corporates. So can you tell us a little bit more about them?
Certainly. So our strategy really focuses on capital protection and competitive income returns, as I talked about before. And what we're really focused on in assessing those opportunities is what we call the 4 key considerations, or the 4 C's of credit investing, which is we look at the collateral that's offered by the borrower, we look at the covenants that we apply to the borrower in terms of various ratios that we apply in measuring their performance, and we also look as importantly, I should say, at the character of the borrower as well. So we assess the management team and like to ensure that the management team can operate the business through both good times and bad times. So typically the way in which we design our loan terms to achieve the attractive returns that we're after is we're looking to make sure that those loan terms are commensurate with the risk that we're seeking to take. So the returns that we achieve aren't driven by base rates or the cash rate, but rather an assessment of the risk of the particular loan such that we do achieve that high single-digit to low double-digit net return over the full investment cycle that I talked about. It's fair to say, Graham, that each borrower that we see is a bespoke loan. We don't do cookie-cutter style lending. This is not mortgage-backed lending, which has its place, of course. But really what we're looking at is a variety of industries. We're quite agnostic about industries that we look at, and we're looking, as I say, at the underlying collateral and security structure to ensure that we have been able to assess all of the credit risk on the loan. And in doing that, as you can see here on the slide, we apply quite a well-developed and well-defined credit risk process that has been developed by our team over the past 20 years, and we continuously look at improving that process and applying that to every loan that we look at. So over that period of time that we've been doing this, particularly during the GFC, as I mentioned before, we've found that lending against business assets, including debtors, inventory, plant and equipment, and occasionally property, has actually served us better over that period of time because it provides investors with a diverse asset exposure that can be easily secured by taking what we describe as a all securities charge or a PPSA charge over the business, as well as a mortgage over any real assets that might exist in the business. And this can also, in some cases, be further enhanced by personal guarantees of the borrowers. Typically, we achieve those with private companies, not always available with some of the smaller listed companies that we might lend to. So in terms of, as I said, the type of businesses, we are industry agnostic in terms of what we look at, but we're generally speaking looking to lend to businesses who have consistent cash flows. And businesses that are typically less impacted by economic cycles. So they might be doing business, for example, with larger corporates or a number of government entities. So the quality of their debtor book is something that we really like to focus in on. This exposure, in our view, tends to provide our portfolio with a form of underlying credit arbitrage. And what we mean by that is that the credit position of the borrower that we're lending to, who is typically an unrated borrower, is enhanced by the fact that they're doing business with large rated borrowers or, as I said, even government entities. So we're therefore looking for businesses that are growing and are typically seeking additional working capital to fund their growth and expand their asset base. And that could be as a function of some M&A or corporate activity that they might have going on. I think lastly, what I would just say is in terms of businesses that we don't look at, as I mentioned, we're largely industry and sector agnostic, but a couple of exclusions would include mining exploration, which is quite a specialist sector that is well serviced by other managers. Also, Main Street retail is not a favourite area for us, and probably the road transport sector are the three that I would call out in terms of industries that we don't look at right now.
So, in the current environment, like what do you think is happening at the moment, and how would you be addressing that?
Thanks, Graham. I'll take this one if that's okay. Look, the current market environment. I mean, certainly we're seeing very strong tailwinds in terms of the opportunities that are being presented to us. I don't think in the 20 years that we've been doing this that we've actually seen more sort of reasonable or more opportunities in the space that we want to play, both from a size and a quality perspective. We source all of our opportunities generally through a trusted network of advisors, and our ability to communicate to those people what we're after and what we require really does enhance the quality of what we come through. And at the moment, we're certainly seeing a lot of opportunity. Why is that the case? I guess firstly, the banks continue to struggle with the regulatory environment, particularly the cost of lending into this lower middle market unrated sector. If you overlay with that at the moment, clearly some of the banks are more reliant on capital markets funding, both domestically and internationally, and the cost of that, as we all know, is only increasing. So from a price competitive perspective, as well as a capital management perspective, we're seeing them play less and less down in this sector. At the same time, this sector is growing. The private company sector and the lower mid-market sector is growing all the time in terms of its importance to the economy and the burden that it carries, if you like, in providing opportunities and providing services to a raft of much bigger companies. As I said, there's over 60,000 enterprises in Australia that have collectively about a $500 billion borrowing requirement per annum. So again, a big increase in the number of opportunities we're seeing across a wide range of ANZAC sectors. Significant ongoing opportunities in the market, for us means that we've still only reviewed just over 0.5% of what is the available market there potentially. Banks have traditionally played as much as 90% participation in that sector. But we all know that where that's trending. So whilst the opportunity set at the moment is very large, we think that relative to our overseas peers, if you look at certainly the US market and to a large extent now the UK and European markets, that the amount of funding that is provided by private credit lenders, is significantly higher than what's happening here. So we still think that the growth opportunity still has a long way to run out here. There is significant depth and diversity in the opportunity in terms of the sectors we see it coming from, in terms of the types of transactions, the industries they're in, the regional locations, as Mike has talked about before. So all of these are risk mitigants in terms of providing greater diversity, not just by the industry group that people are in or the stage of their development, but also by where they're actually located and what the microeconomies are doing in that space. And as always, we are always looking for quality counterparts who meet all of our requirements, but then behind that are actually servicing high quality companies. And that's another, if you like, a form of credit arbitrage, a look through to those sort of companies. As always, we're always mindful of the risk in every opportunity, and part of our due diligence process is getting on the ground and into the weeds with individual companies, meeting not just the management, but actually seeing how that management engages with the rest of their team to make sure it's a cohesive sort of functioning unit and there's not too much key man risk.
And maybe going into some of the risks in a little bit more detail, there'll be some common questions that investors might have about the economic risk, insolvencies, which we've seen. There are company and sector-specific risks. So how do you also identify and monitor those risks, and what do you do in working them out?
A large part of our process is certainly is our ongoing due diligence to get us to the point of final documentation and closing a transaction and final approval. But then there is an ongoing monitoring program that we have, and we would describe ourselves as a high-touch lender in the sense that we maintain contact with multiple points or multiple people within an organisation to make sure that we're getting a cross-section of updates, news, and we're always being kept abreast of what's going on. We have regular financial reporting, but we also want to know what's their pipeline look like, what's their customer mix, are they winning or losing business, how the competitive landscape in their space looks. So by staying in contact and maintaining, as I say, multiple points of contact, it gives us the ability to actually track those trends quite early in the process. We build in what we call pretty much standard financial covenants, interest coverage, debt service ratios, and then monitor on a quite a regular basis. So everyone is reporting to us sort of hard and in depth on at least a quarterly basis, and in many cases on a monthly basis, depending on the nature of the business. We track obviously industry trends across all the ANZAC sectors. We're watching to see which sectors are early indicators of potential stress in the economy and where that's coming. We try and avoid products or people who are in the business of providing really super niche products unless they've got a highly identified marketplace. So we're looking for more generic type businesses that we think have the ability to ride through sort of tough times. Our approach is to work through borrowers when they do meet potential unforeseen challenges. So we very much encourage our borrowers to come to us early if there is a problem, because our experience over that 20-year period tells us that if you engage early and openly, that in the vast majority of cases you can actually engineer a suitable outcome for everybody and get the ship back onto onto an even keel. I guess it's probably fair to say that most of the challenges we see generally are external, in the sense that a company there is an external impact on them, which is sometimes the flow-on effect from a supplier or a significant customer. But generally they can be mitigated, and we move forward.
So the timing and nature of distributions, this being an income fund, how does that work?
Yeah, thanks, Graham. Distributions are paid on a quarterly basis, and the target minimum return there is 2% net to investors each quarter. They will generally be paid within 15 days post the end of the quarter, once we've had the NAV struck.
Mike, Tim, any final thoughts before we wrap up?
Over 20 years, we've always focused on this lower middle market sector, and the reason, for our focus there is because we think it actually adds some incremental value to investors. It adds certainly some differentiation. It brings different drivers to the marketplace. It's certainly a much less competitive space in terms of, in what is a very broad church of private credit, there are relatively few players down in this space, and certainly relatively few if you take out property backed transactions. So we've been here for 20 years. We hope we're here for another 20 years. But we're seeing some really interesting developments coming through. As I said, coming through the pipes, and we're very much committed to the space.
And Graham, I think I'd just add to that by saying, as Tim mentioned, we've been doing this for 20 years and want to keep doing it for a good amount of time ahead. What we enjoy most about it is that what you're doing is you're interacting with real businesses, businesses that are the backbone of the Australian economy. It certainly means that you don't do every transaction that you see. In fact, in some of the statistics we talked about earlier, we've reviewed $2.8 billion worth of loans to invest in $140 million worth of loans, for example, and that's across 40 different loans that we've done in our current fund. So it's a market that requires a lot of skill and insight into assessing credit risks and challenges, being aware of the fact, as Tim alluded to before, that businesses do hit speed bumps, but they are real businesses, and the beauty is that these businesses do employ the vast bulk of Australians. So, what we're doing is lending to a sector that is helping the overall economy grow and provide employment.
Great. Thanks, Mike. Thanks, Tim. And wrapping up from us, please look at the Partners Private webpage and you'll be able to find details about this fund. It's an open-ended fund. Applications are monthly. And please get in contact with whether that's your advisor or your investor relations contact. Thanks very much.